So for every dollar of NOI increase, you multiply that by $19. So if we take 19 and multiply it by 400,000 on day one, that's a $7.6 million increase in value. This property has averaged 96% occupancy. Its break-even occupancy is 73%. And so how do you take a property at 96 down to 73 when you're keeping the same award-winning staff? And so the current insurance is like $1,300 per unit, Kyle. And we are down in the $600 range per unit.
Oh, wow.
And that's because our master policy is tied to properties in Indianapolis in the Midwest. That savings, Kyle, combined with some other easy savings from our due diligence, adds up to about a $400,000 NOI increase on day one.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. All right, welcome back to the Doctors Investor Club podcast. Today we're bringing back a repeat guest, Mr. Curtis Edwards, managing partner at Hudson Investing. Curtis was on a previous episode where we walked through his background and approach to multifamily investing. For those who may not remember, Curtis has experience in capital markets, investor relations, and cool enough, he worked for Stryker Medical as a medical sales rep, and so he understands how physicians think about risk and decision-making. Today, we're going deeper. Today, we're going to talk about Hudson's current raise called Maple Knoll as a case study to unpack how disciplined investors evaluate markets, manage risk, and think long-term. Curtis, welcome to the show, sir.
Good to see you again, Kyle, and glad to chat with you here on a Sunday and take a little deeper dive into Maple Knoll.
Absolutely, man. Yeah, let's just get started with it. We had Kent Ritter on a couple episodes ago and learned a ton about just the way Hudson Investing works, the way you guys think, and we love every bit of it. So let's dive deep into Maple Knoll, and I think, again, this will be a good case study for potential or future investors to just think how things work. How do you guys define your markets? How do you guys do your deep research on these markets? So Maple Knoll specifically, I know that just in reading through it, it's been owned by Blackstone and GE Capital and some big insurance companies. How did you guys at Hudson Investing get involved?
Yeah, that's a good question, Kyle. Ever since Kent started Hudson Investing and then we partnered up, we've been buying bigger and better and safer assets. Previous to Maple Knoll, our largest acquisition was a little over 200 units and around $28 million. Maple Knoll is considered an institutional asset, and I know you talked about that with Kent a couple weeks ago. But what an institutional asset is, right? We're talking 300 plus units. We're talking, 55 million plus purchase price, and that we've always aspired to get up to those assets. But it's hard to make that leap. Usually you have to go year by year and build your track record. Well, locally, we've been making great relationships with key brokers. Our track record as well each year on closing deals and raising the amount of equity needed for the deals as they got larger, right? And we've always closed on time when it comes to that. And so we started to build a good reputation to at least get a seat at the table. But how you beat out 27 other institutions that were going for, this, what I'm calling, award-winning asset, literally, that's a different story and a little bit of a secret sauce as well.
That's awesome, man. Yeah, I did read that it won Property of the Year. And so I don't think I've ever invested in something that won Property of the Year. So first of all, what is that? Is that a designation that we should all know about?
Yeah, no, I had never acquired an IAA Prodigy Award, Apartment of the Year either. And so, Indiana Apartment Association Prodigy Award, they hand those out. So, for a property that's brand new built from 0 to 10 years, right, they'll hand out an award for that property of the year. And then 10 to 20 years, another property of the year. Maple Knoll has won in each of those categories. And really, it's all down to the staffing and the community that the team has built there. This property manager, I remember when Kent walked the units, when we were looking about putting our PSA in, or our LOI, and Kent said, I've never seen a property manager like this. And then we later found out they won the IAA 2025 Property of the Year. And this woman has been at this property for 17 years straight. She lives on property and treats it as if it's her own home. And really, the community events that she's built over the years are very impressive. Sometimes you would see this tight a community and community events in an active adult community. But that's the surprise here. You have post-grad students here. You got 25, 27-year-olds, as well as 65 and 70-year-olds living at this property. I'd say the average age is probably 45 to 50, but it's a really nice mix, at this property.
That's great. Yep. And so before we dive in deeper, can you educate us all on how you guys did beat out all these other investors? I mean, just thinking macro, I know investor or operators that come from California and the East Coast, and they're all trying to go after this market because Indianapolis is just such a desirable market for an investor. So how did you guys get involved? How long did it take to get this property? And just what are the steps you guys had to go through?
Yeah, so we got word, we've been watching this property for a while. It's been a little out of our ability to raise on the equity side. But over the past couple of years, we've made some very strategic relationships on the equity side, where when we knew this property was coming to market through the relationships with the local broker, we decided to underwrite it. And so what happens, Kyle, is everybody that's going in, has to get their best and final offer in, right, by a certain day. And so everybody is underwriting it with not a ton of information, right? Just their own local knowledge, right? And their own model and their own experience. And so everybody does that. And very quickly, you get purchase prices all the way from 50 million, to 58 million. Okay. And then the broker and the seller will get together and they'll just chop off about half of those 27 in this case. So then you get over the first hurdle and maybe there's 10 left. So now you have another week to sharpen your pencils, ask more questions, right? And then you submit your next offer. And really at that point, Kyle, they're picking the top 3 or 4. And the top 3 or 4 that make it there go on to the interview stage. So we made it to the interview stage. It happened to be 3 people out of 27. And those are 1 to 3 hour long interviews with the seller and the broker. And, they're pretty intense, right? And so this some of what was new for us at this size, this institutional size. And so the main thing that the seller and broker want to know during that part is a syndicate of our size, right? An up and coming and emerging syndicate that is growing, right? 100 units to 150 to now 200 unit plus properties. Can we raise the equity? So we spent over an hour going through our plan to raise, the equity on this deal. And we got them comfortable enough with that. And that's sort of a little, sneak peek behind the curtain and in the process and, over a month-long period that it takes, to be awarded this property.
That's great, man. Congrats to you guys. That's a big deal. It's like hitting the next echelon of real estate investing, really, right?
Yeah. I mean, the bigger deals you do, right, at scale and at leverage, right, these deals become safer and it's the same amount of work that's going into the deal.
Yep. I love that. And 300 units, which is awesome. And then when you guys did the underwriting and you had the plan in place that you were going to jump into this, you vertically integrated your property management group a year ago or so. Did you think that you were going to bring your own property management group in and then realize that this group that's already been there for 17 years, award winning, that you realized how good they were and you're like, okay, we'll just off on that for now?
Yeah, good question. The normal process, right, when you have your own property management company and you're acquiring an asset, is your acquisitions team and your property management team during the due diligence will go in and they will evaluate the current staff. They'll meet with the manager. They'll get the current manager's opinions on their own staff. And then both sides kind of separate and come back. And you really determine, right? Hudson Residential determines, okay, we would like to keep 30% of the staff sometimes, right? And then hire our own type of staff into a property. But at an award-winning property like this, you don't want to mess with the secret sauce and success that they've had. So it was really an easy symbiotic process with this local manager of 17 years and our president of Hudson Residential really sitting down. And there were only one or two people that both sides agreed to, let's terminate that position, right? And then let's backfill it and make the current staff even better. And then Hudson would offer all the existing staff, right, and give them a peace of mind that they get to keep their jobs if they so choose. I can tell you all of them accepted, which is exciting. And so now all of them get folded in to Hudson Residential. And so think about all of that knowledge that this 17-year manager, this award-winning property, these community initiatives and events that now get folded into Hudson Residential. And we couldn't be more excited for that as well. Both sides are going to be learning here in a very positive way.
That's great. I love that. Let's talk about the property and the way, let's talk about the reason that you guys love it. Obviously we know Westfield, Indiana is blowing up. I think it's in the last 5 or 10 years, it's gone up 34% in population growth. And then you expect even more over the next 5 years. I mean, we see it all around us, right? Like I live here. You used to live in Carmel, and we're seeing it blow up.
It's 34. Population has grown 34% from 2020 to 2025. I felt it. You felt it. We still do. And it's expected to grow another 10% in the next 5 years. So you're talking about 44% growth over a 10-year period, Kyle, right? And the answer is why, right? Well, it literally comes down, in my opinion, to the size of Indianapolis, right? The Midwest location, and then the cost of living. You know, I think people forget that it's the 11th largest MSA in the United States. And you combine that with one of the lowest cost of livings, Kyle, and you're going to get a lot of people moving to that market. And then if you have great employers like Eli Lilly and these development projects happening, it's a real recipe for success and growth.
Yep, that's great. And honestly, like anecdotally, you know, as a physician here, I see people now coming from Miami, Florida, the East Coast, the West Coast, and I can't believe it. And they're all like, well, there's jobs here, but there's also the community. You can raise kids. It's like such a family environment. I mean, there's parks everywhere, and it's really a desirable place. So it's really neat to see that.
Yeah, and the diversity too. You know, I used to walk the Monon Trail at least once a day, and this property is lucky to sit on two, you know, really well-known trails where you can ride bikes, run, walk, and you can see the cultural diversity changing, honestly, monthly, which is exciting.
Yep. A lot of affluency up this way too.
Yeah.
All right, well, let's get into it. Yeah, let's talk about you've completed due diligence. You have the property. You're going to close on it, in another month or so?
Yep.
So, yeah, what are the next steps and what are the things that excite you with it?
Yeah, I think there were some very unique things during due diligence that excited Kent and I and the team. And if you want to share your screen here real quick, Kyle.
Yep.
Yeah, and so real quick here on Maple Knoll, you know, it's before we completed due diligence, you know, we always like to establish a base case like a double. And so that's a 17% IRR. And when we advertise this deal, it's a 17 to 20 IRR. That's always going to be defined by the double and the triple, on this analogy. But really back to Maple Knoll and things that really excited me. We walked all 300 units on this property, and a couple key things stood out. One, over 140 units did not need new flooring. And so that was a major surprise, meaning, Kyle, that the CapEx could be dramatically reduced. When you reduce the CapEx, you no longer have to force the rents as high to get the ROI needed to hit the IRR. And so it takes pressure, Kyle, off of raising the rent. So it just adds safety. It doesn't mean you're not going to try to increase the rents and find a nice stable top. It just means you're not reliant on that. So that was an amazing find that we could reduce the CapEx spend on this. Another thing we found out is related to insurance. The current owner has a lot of properties in the Texas market, Houston specific. And when you're these big syndicates, you have a master insurance policy. We were blown away, and we've had several private equity groups who are interested in this deal because of the quality of it, where they thought we underwrote it wrong. And they asked us, was that an error? And we said no, and explain what I just did to you. And so the current insurance is like $1,300 per unit, Kyle. And we are down in the $600 range per unit.
Oh, wow.
And that's because our master policy is tied to properties in Indianapolis in the Midwest. That savings, Kyle, combined with some other easy savings from our due diligence, adds up to about a $400,000 NOI increase on day one. And so that's what I want to show on here. It's very rare, Kyle, to take a cap rate, a buying cap rate of 4.5, and have it go up to a 5.14 on day one. That $400,000, Kyle, right, is equivalent, to somewhere between $5 and $7 million of value creation on day one, right before we've even started into our business plan.
Let me just simplify that a little bit. So over the last 4 or 5 years, studying multifamily for the most part, when you talk about NOI, that's basically your profit. And I'm just kind of, going to dumb this down just a little bit, but correct me if I'm wrong too. So your NOI is basically your profit, right? And you can either increase it by increasing revenue or decreasing expenses. And you're doing a combination of both. And then with this cap rate being so low, that NOI, for every dollar that goes up, you're basically increasing the property value by like what, 17 to 20x?
Yeah, and I'll just step in there, right? Because if you look at what is our cap rate on sale, you see how it's a 5.25, Kyle? And so the easy trick is you take 100 divided by 5.25, and what you get, Kyle, is 19. So for every dollar of NOI increase, you multiply that by $19. So if we take 19 and multiply it by 400,000 on day one, that's a $7.6 million increase in value.
Damn. Day one.
Yeah. And so what you want, Kyle, is when you buy a property, you want your cap rate to expand. And so once again, to educate and simplify it, remember your NOI sits on the numerator part of the equation. NOI sits over value equals cap rate. So when your numerator, Kyle, increases, which is your NOI, which is what you want, your cap rate, right? Your numerator and then the end cap rate go up together. They're related, right? Whereas if the denominator goes down, cap rate goes up. Denominator goes up, cap rate goes down. But in this case, we're talking about NOI. So you want NOI to go dramatically up during your first 2 years of your business plan, and that cap rate expands quickly. And so when you see a cap rate go from 4.5 to a 7 on a stabilized year two, Kyle, that's very impressive.
That is. Yeah. I mean, I don't think I've ever seen that, I'll be honest. And,
I haven't seen that spread right that quick. And a big part of that, Kyle, is the insurance on day one.
That's huge. I love it. And that's just knowing, and that's just being in the right area. Like you guys live here, you know this area, but you also have the insurance in this area, and that's where the benefit comes.
Correct.
That's awesome. All right, so then let's talk about increasing the NOI with revenue. Like, what are you guys thinking about? You said you don't really have to do as much renovations as you thought, but are you guys adding any amenities? It looks like there's a pool. What do you think about with improvements?
Yes, Scott. So this is a very easy business plan. We're calling this somewhere between core plus and value add, right? So that would be like a light value add program, right? And the lighter the value add, Kyle, the lower the risk in a deal. And so with this property has every amenity in the book. I mean, it's impressive. The only amenity that this place needs is a pickleball court, to be honest. So we're going to add a pickleball court here. One of the coolest things I saw during the walkthroughs was they have, somewhere around 140, 150 garages on site, which is a huge amenity. And because of those two big bike pass, walking pass, they converted one of those garages into a clear glass garage. They have bike racks all the way through, and you can pay $5 a month and have your bikes stored in there and rent bikes and things like that. And obviously all the mechanic stuff, to inflate the tires and fix a chain. So it's pretty cool. So very light value add on the amenities, Kyle. When you look at the interiors, we're looking to spend around $9,800 per unit and looking to get back an ROI of about 27%.
Nice.
Right? So half of the units, we need to add new LVP flooring, and all of the units have a 2-tiered island. And the number one complaint from the residents is that that's dated. They would like that 2-tiered bar style island to be removed and lowered and have it be a normal island, and then have some quartz, some hard stone material as the countertop. And so, really that's what we're going to do when it comes to that. And when we look at the rents, and we stick to the double here, we can push rents very small, right? $140 after renovations on a 1-bedroom, up to $250 on a 3-bedroom, right? That's a very small increase after renovations, and still be in the 73rd percentile, meaning we can push rents higher as long as occupancy stays there, right? But we're protected. So if competition comes in, or if concessions come in, or other things, we're so far below the top of the market, Kyle, that brings safety into the deal. Plus, it gives us a chance to overachieve when it comes to organic rent growth and post-renovation rent growth.
Love that. Yeah. So real quick, I just want to highlight the trails that you're talking about. So there's 2 trails that go right by it. The Monon Trail being one of them. And, when you think about Indiana here in the Midwest, we don't have mountains. We don't have all these big lakes. We don't have this, beautiful landscape necessarily. And so the Monon Trail is pretty much that for us. It goes right down the heart of, Westfield, Carmel, all the way to downtown Indy. My wife and I walked it yesterday, and it's gorgeous. It's nature walk, but there's also a ton of restaurants and steakhouses and just a lot of amenities on it. And so it's a desirable place, which is kind of crazy to think about. So yeah, speak to that if you can.
Yeah, you can see here on the map, not only do you have the Monon Trail, you have the Midland Trace Trail, and they literally go right through the property. Another thing that's amazing about this property, Kyle, is because it was built in 2008, they were able to acquire so much acreage, right, at a smaller cost than any competition coming in now. This property sits on a ton of acreage with mature trees and space between the buildings, Kyle, for dogs and people to walk around, which is just very unique with all the growth that has happened from Carmel to Westfield. Because now anything that's being built now, they can't buy as much acreage. So the first thing that gets cut is the amenities, and then the buildings get put on top of each other.
Yep. On a personal note, the school that my kids go to is in Fishers, Indiana. They're actually they just bought just south of Grand Park, just north of this property. And there are a ton of people that are going to be they're all trying to move to Westfield, right? They're like, dang, our school's moving, our church is moving. And so everybody's like, I need to find a place in Westfield, Indiana. you can't find a house that's reasonable in Westfield, Indiana, which is kind of crazy to think about. So something like this is perfect.
Yeah.
All right. So moving on, anything else you want to talk about after due diligence?
Yeah, Kyle, one of the coolest things was we had a private equity group come in and wanted to tour the property. So Kent and I went and we were walking around the property with the 17-year property manager. And I mean, dude, I had a notepad out and I was just listening, as you just don't get that big opportunity to walk around somebody with that much experience at an award-winning asset like this. And some of the really unique stories was she was talking that there are 3 tenants, Kyle, that have a net worth over $10 million.
Wow.
Which shows you the location of this property, as well as how they make this property feel like home.
Mm-hmm.
Another interesting stat was there's a couple people, Kyle, that have moved out, bought a home, lived in the home, sold the home, moved back in twice. There's other people that have moved out and didn't like living in a house and moved back in. And then there's other people that have moved out and she always welcomes people back to any of the community events. And there's about 10 to 15% of the weekly events are people that no longer live at the property that come back. And Kent and I had really never seen that, but it's really just free PR and enhances the community. And all of those stories are just so unique for a property, but that's how you win this award twice. And that's how this property, is in such good shape. And I think why this manager really, treats it like her own.
Yeah, I love that. I mean, it's more than a property, right? It's a community.
Yeah.
And that's what she's created, which is amazing. Well, good. I mean, and thinking about this as institutional quality, as you mentioned. So, there's downside risk, there's cash flow. When will you guys start getting cash flow?
Yeah, I think, Kyle, a question I get a lot during the raise is understanding, this is just based on our conservative estimates and what, a double might look like. But in this scenario, Kyle, right, there's a 7% preferred return on this. And so people say, well, why is year one 5,800, which is 5.8% on 100,000? Well, when you're doing a value add program, right, and you're being conservative, usually year one might have below the preferred return. And so that's what we're showing here, Kyle. And then you can see the preferred return picks up. But the unusual part about this deal is there's a big payout in year 2. Well, the leverage on this, Kyle, is so low, 52% when we go in through agency debt. And that's good, right? Low leverage is really good. It's safe. But we're increasing the NOI. How much on day one? Do you remember?
400,000.
Exactly. And we are going to put in our rapid renovation program and have all the renovations done, Kyle, in 3 to 6 months, therefore increasing the rents during that first year. And so there's so much value creation, Kyle, between years 1 and 2 that we can go back to the bank, and it's called a supplemental loan. And you can get an appropriate amount of supplemental debt, right? And keep that leverage in a very low amount. And now you distribute some of that loan and those proceeds early to investors, okay? And so that comes back at that point. That's a return of capital, okay?
Mm-hmm.
And that's good. You want your capital back. You still stay in the deal for the exact same percentage as you came in, but now you get your money back and you can do whatever you want with it. That is a very good thing.
Yep. And it's tax-free because it's return of capital, right?
Correct.
Yep. And then another question I had on that. So Curtis, I heard an analogy the other day, and I'll really start with this. As a physician, like 7 years ago, I was trying to study this stuff, but I didn't, know it well. And we always thought high risk, high reward, right? To get wealthy in investing, you got to throw your money at something that's risky and expect a good return and basically hope you hit a home run, right? And so over these years, I've learned that I don't like a ton of risk. I like certainty. And so somebody gave me this analogy the other day, and I thought it was spot on. The movie Moneyball, or the book Moneyball, where we talk about the Oakland A's back when they had little money compared to the Yankees and all these big, teams, the Dodgers, the Yankees, the Red Sox. And so what they had to do is find players that just get on base, not hit home runs, not, hit home runs and then strike out a bunch. They're consistently getting on base a lot. And if you do that enough, you'll score a bunch of runs, right? And it worked for them. And I liken it to investing in these deals that spit off singles, doubles consistently. And so that money will continue to work for you. And then it compounds into the next deal and compounds again and compounds again. Instead of trying to hit a home run, well, then you go over for a while and then you're just losing that money, right? So, I kind of like your guys' baseball analogy because it reminds me of this.
Yeah, we started this slide a while ago. And first of all, great movie, by the way, that came from, the real life story, Moneyball.
Yep.
But we started this slide to be transparent. A lot of investors want to understand what's happening in the model in all of our different scenarios. And so this is our baseline. We're always going to underwrite to that double, that base case. And you can see that our likelihood is 85% between the double and the triple, right? And that's good. We want to be conservative in our underwriting. So I do a lot of education on what does conservative underwriting mean? Well, it means, Kyle, using 3.1%, for the whole period average rent growth, even though the submarket is expected to grow higher than that, right? We'll use a 30-year average versus what's happening right now. Another conservative aspect here, as we talked about, we only need to push these rents into the 73rd percentile compared to the peers around this property, same type of class and quality. And so that's a ton of protection there. When you look at our business plan, a lot of our CapEx, Kyle, is actually reserves for HVAC or roofs that aren't initially needed, but we have those reserves there. And those reserves, if they're not needed, come back to investors, right? And so that's why I love the baseball analogy you brought up. It ties in well. And this slide gives very advanced investors and very beginning investors a lot of information that they can digest and feel comfortable with the deal.
I mean, from what I'm seeing here, like obviously double, triple, you have the highest percentage, but from your underwriting, you have a better chance to hit a home run than you do a single, right? Which is probably worst case scenario.
Yeah. And that's how this is, especially after we've gone through due diligence. And I would tell you after due diligence, right? And we don't change this when we launch the deal. We launch the deal before, we really finish due diligence, and then we get all our quotes and our bids. But we can kind of tell early on if a deal's going to stay right at the double for a while or if it has a good chance to overachieve. And we've seen a lot of positive things during due diligence on this. But yeah, you'll notice on a lot of our decks, the chance of hitting a triple and a home run is more likely than the single. Our single, Kyle, is our equivalent of, I get this question from every investor. What is the worst case scenario, right? And just like buying a stock or investing in crypto or venture capital deals, the worst case scenario is the answer is always the same, right? You lose everything, right? Like anyone that's investing in anything, that's the worst case scenario, but that's not reality. And so for us, right, with our track record, we've never done that before, right? And we have 9 of these other properties in the same area. This property has averaged 96% occupancy. Its break-even occupancy is 73%. And so how do you take a property at 96 down to 73 when you're keeping the same award-winning staff?
Mm-hmm.
And so as I educate people there, they start to understand, okay, a single, Kyle, is lots of things in the economy going wrong. Your stock market's probably down 15 or 20% in that scenario, Kyle, right? But these properties are really recession-proof, inflation-proof, right? And so a worst-case scenario in this, Kyle, is you have dramatic job loss, population totally changes and moves out of the northern suburbs of Indianapolis. And we still feel like, there's a way to salvage, and get that single here.
Mm-hmm. I love it. That's great. Great explanation of it.
So that's
So
the only difference in your Moneyball. Moneyball, you win a lot of singles and doubles, right? The baseball analogy connects, but the single here, which is like what Moneyball is built on, right? That's not a scenario we've ever hit on our track record at Hudson. Our average return on our exits is a 23.02, and we have about 6 or 8 deals we're going to be selling over the next 2 years. As the market picks back, institutional money comes back in. We get a new Fed chair here in May, and hopefully we get some interest rate reduction. When that happens, Kyle, we feel like our average is going to climb even higher from that 23.02.
love it. And then do you mind if I ask about like the tax benefits of this? I mean, I think a lot of our listeners probably know to a degree, but what should they expect with the tax benefits? Say they put $100,000 in, what kind of tax benefits will they get out of that?
Yeah, great question. So with bonus depreciation coming back, we like to give a range of what we can expect. And because of last year and what we saw there, we're anticipating 55 to 70% of every dollar invested. So 100,000 invested, somewhere between 55,000 and 70,000 back in year one, Kyle, as a K1 passive loss. Remember, that can only offset passive gains.
Mm-hmm.
And if you're a real estate professional, it can offset really any of your taxes. But for everybody else that has a W-2 job and doesn't have passive gains, that loss stays on their accounting ledger until the investment matures and we sell the asset. And then at that point, if the client wants to take some money off the table, they have losses to shield those gains. And that they can't get, with the equities market. And so I always say it gives their team, their financial advisor, their CPA, it gives them more tools in their tool belts, Kyle,
Mm-hmm.
as they grow their wealth and get towards retirement.
Yep, that's great. Good answer on that one. You simplified it well for us. So, what are some last bit things that you want to talk about with this deal and specifically? This is really the first time we've done a case study like this, so it's actually pretty cool to see. Any other big things that you want to touch on?
I would just touch on, I think Kent talked about it a couple weeks ago. Whenever you are the first person to get a bite of the institutional apple, right? It's been passed from one institution to the other. Usually they keep occupancy high at the sacrifice of leaning into rent increases to make it easy. Their expenses are very high as well because they have more protocols in place. So the properties are immaculate. And usually the first person to get the bite of that apple, that's more entrepreneurial mindset, right, Kyle? And can have some small reduction in expenses to keep the same quality and lean into that very large rent gap because we're local and we understand the market better, right? The opportunity to overachieve and the opportunity for a very safe, great return is very high. And so that's why Kent and I both feel this is one of the top deals we've seen in our careers. When you look at this slide here, the risk, look at that blue line. The risk is way over to the left, almost like a core plus asset, yet the return is up there and it's conservative in our model up there at a development range with already really good positive signs to overachieve. And so it's just a great quality deal in our backyard. And it all comes down to that first bite of the institutional apple.
Yep. Very well said. Yeah, no, this is a really good one. It's cool to see all this. It's amazing. I appreciate you bringing up the pitch deck too, just to get some eyes on it.
Yeah.
But it looks like a beautiful property. Truth be told, I drove by it last week because again, it's 8 minutes from where I live. So, but yeah, I actually want to go to one of these events that she puts on.
I know. I mean, they've had sushi rolling events several times, pizza parties. They've had dog grooming events. They've had their own, dog show and stuff like that. So it's truly impressive, Kyle. The raise is going very well. I anticipate, this closing, on the equity side over the next couple weeks. So if any of your listeners are interested in this, have them get a hold of you and, And like I said, it's a great opportunity to invest, in a Midwest institutional asset.
Yep. Very good. And just real quick, plug, where can they find you guys again? And where can they see your track record? I know that's one thing that's always talked about. Where's the best place for them to see that, to get some eyes on it?
Yeah, if you go to HudsonInvesting.com, under the offering tab, you'll see Maple Knoll, and you can request the full offering memorandum that has our track record and has the ability to get a hold of me. My email address is just Curtis at HudsonInvesting.com. And so via the website or through you or my email, they can gain access to this deal.
I love it, man. Thanks for coming on. This is awesome. Coming out of Telluride, Colorado.
Yeah, man, I appreciate it. Always fun to hang out with you on a Sunday, Kyle. We'll do it again soon, all right?
Absolutely. Thanks, brother. Appreciate you.
You bet, man.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.
This is my time. Ready to shine.